Hello everyone, welcome back to the channel, your number one source for income-oriented investing. And I recently released a new video called The Great 16 for the Canadian market, right? 16 ETFs that are diversified, use some leverage, you could buy and hold forever, yada, yada, yada. So I did do this on the American stock market. And I know many of you have been messaging, where is the updated US version? Well, the one you're looking at here, which the US version, the first one, and I don't think I came out with a second version, by the way, called the Great 11. I did 9 months ago. And the premise behind the Great, whatever it is I'm trying to tell you, in my opinion, what are the top high yield covered call ETFs you could buy and hold forever. You could use as building blocks, foundational positions or core positions in your high yield covered call ETF portfolio. But a lot has happened since 9 months, and I'm surprised to see the video almost has 60,000 views. So I have to, obviously I'm going to do an updated version, but the problem on the US market, it's very different from the Canadian market because there's just a tons of covered call ETFs that actually could technically make the cut, right? That you could consider as your core foundational position. So what I'm doing here is I'm going to do the great whatever S&P 500, NASDAQ 100, US large cap. There's so many that I'm going to separate it in 3 separate sections. And I really feel like, you know, in the US side, even though you could consider even maybe the Russell 2000 as a buy and hold core position, which I think you can, I'm going to stick more in the big caps space. My opinion, you know, if you just look at S&P or NASDAQ 100 versus Russell 2000, you'll see what I'm talking about. But essentially in this video, we're going to cover all the great S&P 500 covered call ETFs. And the next one, so this is technically episode 1 of covered call ETF battles, but I'm going to integrate it into, the great whatever. So anyway, I know I'm rambling on, but I'm just trying to tell you how I see this. Now, because the US market is so big, I decided this episode we're going to focus on what I feel is one of the most, the king of kings when it comes to benchmarks. Everything's compared to it. 95% of active funds don't beat it. The S&P 500, right? The top 500 companies in the US by market cap. We'll focus on, in this specific episode, everyone, only S&P 500 covered call ETFs. So we're going to go through all of them because I think the S&P 500, whether it's covered call or not, could easily be a very good core building block or core position in your portfolio. Of course, this channel focuses on income, so we're going to focus on the covered call ETFs one. Now, I know you're going to say, well, where's this? Where's that? Why is JEPI not here? These are only going to be the official S&P 500 covered call ETFs. Next episode, we'll do NASDAQ 100. The episode after that, we'll do US large cap, which will be, not exactly indexes, but JEPI will be there. Things like YMAX will be there, etc., etc. So 3 separate episodes to tell you about the great S&P, the great NASDAQ, the great diversified large cap. Income oriented, of course, that you could hold in your portfolio as core positions. Of course, these are all my personal opinions. So what I'll do is I'll go through all of them. We'll look at the total returns. And then at the end of the video, I'm going to give you my opinion on which are my favorites. If I was American, if I still invested in the US stock market, which one I would strongly consider. And really, I'll go through each of them and say, look, this one is designed for this type of investor. This one is designed for if you want this. This one is designed specifically if you want this. There is no right or wrong here, right? And the criteria that are really going to be looking at is distribution, yield, distribution frequency and consistency, yield, fees, very important, total return, right? So these are all factors that you need to consider, but some factors are more important to other investors than others. Some people want higher yield. Some people want very consistent distribution. Some people like more classic strategy versus zero DTE. So this video is all about the S&P 500 covered call ETFs. I'm going to show you all of them, teach you the differences between all of them. Let's start with what I would consider the benchmark that I always use to compare any S&P 500 covered call ETF. This is what I call the classic one. Okay, classic Coke. the baseline classic one, the Goldman Sachs S&P 500 Premium Income ETF. If you want something classic, this is the one. It's the S&P 500 with covered calls. The fee is very, very low. It's one of the lowest ones at 29 basis points. Net expense ratio 29, gross 35. I don't know why they have this in the US. Can you just tell me what it is? Is it the net? Is it the gross? I don't even know. But I'm assuming net, it's the net, right? 29 basis points. So this one has a very consistent monthly distributions that varies. You could see the history here. But typically the yield is always approximately 8% annually. So it's not the highest yielding one, but it's very, very consistent. So if your yield is 8% and the S&P 500 on average gives you 10, 11, 12, 13, 14% annual return, you will have some capital growth with this one, right? 8% yield, and probably, you know, if the average of the S&P 500 is 12% a year and you're getting 8% yield, well, guess what? Your capital is going to grow 4%, right? 8 plus 4 equals 12. So this is what I consider classic, okay? SPY-I, another classic strategy, right? We're going to do the classic ones first, then we're going to do the zero DTE ones after, then some honorable mentions. SPY-I from Neos, expense ratio 68, a little bit higher than GPIX. This is also what I would consider a classic strategy. The yield is a little bit higher. Okay, the yield is typically it's 12%. 12% typical yield, very, very consistent monthly distribution. So both, you know, GPIX and SPY-I both have very consistent yields, consistent monthly distribution. So if those are important for you, these are good ones to consider. But we'll do the summary at the end here. So very similar to GPIC, except the fee's a little bit higher, but the yield is definitely higher at 12%, right? So if the S&P 500 average annual return which is about 12%, you know, this one you could expect basically your capital to remain more or less stable and get a 12% yield, right? So anyway, we'll go through it at the end. They also have another version called SPY-H, which is like SPY-I, but they're doing some hedging, so it's even lower risk than SPY-I, in my opinion. I personally don't like the idea. If you just do, for example, SPY-I versus SPY-H, SPY-I is winning. In terms of total return. So not only do you have better yield, but you have better total return as well. The management fee is the same, but you know, I guess if you just want some extra added protection, which a cover call strategy already does, you could consider this one. But this is not one I would get. The yield is, you know, significantly less because they're taking a portion of that yield to probably buy some puts or something, some hedging, right? Next one in terms of classic strategies is IVVW. This is going to be the lowest fee one. No surprise, it's BlackRock, 25 basis points. So lowest fee. This is also not an active strategy. This is a rinse and repeat strategy where they're doing a 1% out of the money call every single month. So rinse and repeat. You see that here. Enhance 1% out of the money, buy right index. So the distributions on this one are not stable or not consistent, but the yield is pretty high, right? You're doing 1% out of the money. So you're giving up more upside than SPY-I and GPIX is doing. We'll look at all the performance in a second. So if you look at the distribution yield right now, it's 17%. Where do we find the average 12-month distribution yield? I can't find it, but it's typically higher. You're looking at between 14 to 20%. It's typically higher here. And this one, obviously, they just hold IVV and they write 1% out of the money call option on it every month. You could actually see it right here with the strike price as well. So this is a very simple rinse and repeat strategy. Next one is from Granite Shares. It's a bit newer. The Granite Shares Yield Boost SPY ETF. The stock symbol is YSPY. So this one, the yield is just astronomical. It's a weekly dividend. And they're basically doing put options instead of calls on leveraged S&P 500 ETFs. So the premise behind this one, and I've had Will on the channel to talk about his Granite Shares Yield Boost. He's been on other channels as well. So what these guys do is basically they write the options or writing put options. That's the first twist but they're writing them, instead of writing them on IVV, on just the regular S&P 500, they're writing them on the leveraged ETF. So if we look at the total return, by the way, the management fee is the highest, 1.07. But if we look at the total return between these 5 classics, or, well, SPY H, sorry, I mean, Y SPY is not exactly classic, but I put it in the classic category because it's not a 0 DTE, I believe. But if you actually look at the total returns, and some of them have been out for over a year, obviously the more time we have, the better we could look at. But GPIX, is a very, very good total return. You see that it's 15% total return, a little bit higher than SPY, which makes sense because if the S&P does well, the person who's writing the least amount of the less covered calls is going to have higher return, right? But then of course in a period where the S&P is flatter down, the person who's writing more covered calls outperform. So GPIX and SPY are pretty much in line. You see year to date, it's SPY has a bit of an edge, but over 1 year, they're very close, okay? Very close, what I consider classic strategies. IVVW, that rinse and repeat strategy is lagging behind. Makes sense. 1% out of the money means you're giving up a lot of upside on the S&P 500. Why SPY? We don't have a year of data. We don't have year to date, but we have 3 months, and it's outperforming everyone, including the S&P 500. This is just the S&P 500 regular. It's not even IVV. It's just the S&P 500. So why SPY? It's definitely one I would keep monitoring, keep my eye on, because right now it's destroying everybody. Will that be the case in a year after a crash? I don't know. We'll have to follow it and see what happens. And SPY H a little bit behind SPY I. Personally, I don't see a point, my opinion. But you could see that they're performing fairly well, especially GPIX, SPY. You're always gonna have to expect a little bit less than the actual performance of the S&P 500, but we're not investing in cover call ETFs for performance. We're investing in them for the consistent yield. Moving on to the 0 DTE. So the next 5 are going to be all 0 DTE strategies, which are 0 days to expire. So they're basically writing options or doing cover calls every single day, daily. So the first one is XDTE from Roundhill. This one, the yield is very high at 25%, and it's usually near 25%. The weekly distributions can vary, but they're pretty consistent if you ask me. You have the history here. You can look at the history. So this is the first one. This is, I consider, a classic 0 DTE strategy, right? You could even see the options here. They're basically writing them on the SPX, right, daily. Next one is SPY-T from Defiance. So this one is interesting. The thing that's different about this one is they target 20% annually. So this one is always going to have approximately 20% annual yield, and they do a daily spread. They do a daily covered call spread. You could actually see it every day on the S&P 500, right? They hold IVV and they do a daily spread, which means they sell a covered call at one price and then they buy a call on the S&P 500 at slightly higher price, and that's the spread. That's why it's called a spread. So this one, by the way, sorry, I forgot to mention the fee for this one. The fees for the 0 DT ones are going to be higher, obviously. You have 97 basis points. SPY-T, what is the fee? It's 87 basis points, it looks like here. Next 0 DTE one, XDTE, SPY-T, fairly consistent distributions near the 20-25% yield. SPY-T is target 20. You have iSPY. This, I believe, is the lowest fee 0 DT S&P 500 cover call ETF from ProShares. This is a classic 0 DT strategy. I think it's 55 basis points. Right? Yeah, here it is, 55 basis points. So this one, the yield is one of the lowest. You see the 12-month average is even under 12. And the monthly distributions, I would say the negative about this one, the monthly distributions are just all over the place. You could see the history, but it varies greatly. So if the yield is much higher, like for example, April and May was a much higher. April was Liberation Day, the volatility spiked. So you see in May, they gave out a giant distribution, and then volatility went back down and the distribution went back down. Remember, guys, these option premiums that they're taking in is based on volatility. The next 0 DTE one is from Tap Alpha called T-SPY. They hold the SPY. They write daily covered calls. Total expense ratio 77 basis points. The management fee 68, but the expense ratio is 77 because they actually hold the SPY in the ETF, right? So they hold, where's the holdings? Is it here? Yeah. So they hold SPY and they do a daily covered call. That's it, guys. Very, very straightforward. Very, very consistent 14% yield, which is nice. A little bit higher than the SPY, for example, and very consistent monthly distributions. You could check out the history, but this one I would say it's very interesting. Very, very consistent. Then there's SDTY, which is a very similar strategy to XDTE. This is from YieldMax. It's as classic, I would say, 0DTE cover call strategy. So if we do the total return comparison, SDTY, we don't have 1 year of data yet, but they're fairly close. After 1 year, T-SPY is the big winner by far in terms of total return. Okay. But the other ones are, a little bit more behind. SPY-T not doing too bad after a year, but they're relatively close. And, once we have more data, of course, as the years go by, we'll have more data, obviously. But right now, T-SPY is the winner. And I believe T-SPY, out of all of them, the classic and the 0DT, is one of the top performers. So, before we go into some honorable mentions, sorry, I don't know why I scrolled back up there. So let's just go through some honorable mentions first, and then I'll give you my opinion on which one is for which investor, what you're looking for. So honorable mention number one, or dishonorable mention, if you will, is XYLD. This is actually came out a long time ago. This is an original with QYLD. The problem with this one, why it doesn't work, is because they're giving up all the upside. It's the strategy. They're doing it at the money calls on the whole portfolio, and then they hold back. They only give 1%. So the yield, it depends on how the volatility is, but it's typically between 8 and 13%, something like that. You see here the 12-month. The problem with this one is the performance is not good because you're literally writing too much covered calls. They're writing the maximum amount of covered calls. So, the performance-wise, it doesn't work. If we just do, for example, XYLD versus GPIX, which I always use GPIX as the standard benchmark, you see that there's a big gap in performance, right? So you never, the problem with covered calls is that if you're doing it on something that does well and goes up over time and you're doing too much, you're not gonna have good performance, right? You're gonna have terrible performance. This is why I personally really like the Canadian fund managers who nobody goes over 50% coverage, and sometimes they even do less than that, right? So they have XYLG, which, and by the way, XYLD is a rinse and repeat strategy. Management fee is 60 basis points. They do have XYLD and XYLG, and all they do is we're going to cover 50% of the portfolio instead of 100. We're doing at the money calls, but on 50% of the portfolio. Now, of course, that strategy is going to work much, much, much better because you're doing less covered calls. So, for example, XYLD versus XYLG, XYLG is doing much, much better. The reason why it's an honorable mention is because the yield is really, really, really low. The yield is typically 4 or 5%. It's typically always going to be half of what XYLD gives you, right? So performance is good, yield is low. My opinion, if you're better off with GPIX, that's my opinion. WDTE from Defiance, the reason why it's an honorable mention is because the performance is not that great. I don't think the strategy is working really well. This one does 0DTE put options. I feel they're doing too much covered calls, obviously. The yield is really, really high. It's one of the highest yielding ones. It's weekly dividend. It was all the rage. I was very excited. I think I even owned it at one point, then I swapped it out because if you just do, for example, WDTE, DTE versus GPIX, you'll see that there's a pretty big gap in performance. So to me, the strategy doesn't seem to me working well. It kind of reminds me of IVVW maybe because they're just doing too much covered calls. Even IVVW, which is not a great performer, is actually beating it. So if the Defiance one, the SPY-T one seems to be a much better strategy. Then there's RSPA, which is an S&P 500 equal weight covered call ETF. So instead of market cap weighted, they equal weight. So you have equal weight to all 500 companies. This makes zero sense to me because you're basically selling selling the winners for the losers, like Michael Saylor always says, right? Why? This is to me is like the ultimate DEI type of ETF, because you're giving everyone equal weight when it shouldn't. Like Microsoft and Apple, and those are much better companies than the bottom ones. Why are you giving me an equal percentage? So to me, it doesn't make sense. If you do RSPA versus GPIX, for example, GPIX is outperforming. I think it will always continue to outperform. If you look at any long-term growth S&P 500 versus S&P 500 equal weight, the S&P 500 one normal market cap always wins. All right, so that's it for the great S&P 500. Let me go through very quickly my words here for who each one, if you're trying to decide which one, you can't decide. Don't forget you can mix and match. There's no right or wrong. It really depends on your goals. But if you're an investor who just wants the classic, a low fee classic strategy proven that's going to have good total returns over time, and you're not super hungry for yield, you're okay with 8%. Also, if you're someone that is really bullish on the S&P 500, you're good with 8%, you want to see your capital grow a little bit, GPIX is definitely right for you. If you want maximum yield, good yield, higher yield, but you don't really want your capital to remain the same over the years, right? If you want to put $1 million, $100,000, you don't want your 100,000 or $1 million to move that much throughout the years, and you want to be able to spend all the income without worrying, SPY-I is a good one. SPY-I is the yield is close to the return of the S&P, so your capital will remain more or less intact. Whereas GPIX is going to go up a bit, but with this one you're getting a lot more yield. You're getting 12 instead of 8. SPY-H I feel is a waste. That's just my opinion, right? It's for people, I guess, that are really scared of investing in the S&P 500. But if you're really scared, then you would get it with a covered call anyway. This is just an added protection. IVVW, look, if you want low fee, if you like a rinse and repeat strategy for some reason, you're a little bit bearish, right? Because you can only capture 1% upside of the S&P every month by default. You could consider IVVW. Personally, not my favorite. This one is interesting. It's innovative. It's an interesting concept. The total return has been really, really good lately. I don't know how it will fare in a crash, but this one is definitely interesting. Very high yield, weekly distributions. I don't think it's proven itself yet, but after a year, if this one is just going to destroy GPIX and SPY-I, this is definitely one I would consider. So the next one in the zero DTE space, if you like the zero DTE strategy, which I kind of like, I like it. You just got to be the biggest nightmare for a zero DTE strategy is there's a day and the stock market goes up extremely, extremely hard. Like there was one day in April, which zero DTE cover call ETFs were doing really, really well. And then after that day, they're all a little bit lagging behind GPIX. So in terms of the best performance, if you want consistent, if you're happy with 14% yield, if you don't want too much cover calls and you like total return, this T-SPY is definitely the one to consider. It's the highest total return. iSPY, yeah, it has the lowest fee, but the yield is not that high. The distributions are all over the place and it's not outperforming T-SPY. So I don't really know why you would bother with iSPY. That's just my opinion. XDT is more of a classic, weekly dividend, classic strategy, good. In the past it had some variance with the distributions. Now they seem to be a little bit more stable. So remember, guys, zero DT is fairly new. So as time goes on, these fund managers are going to get more experience. So you're looking at 25% yield. If you're happy with 20, if you look, I want a nice fixed 20% approximate yield, SPY-T could be definitely a good one to consider as well. The specialty about this one is that close to always 20% yield. And SDTY is good too. It's weekly. It's from YieldMax. If you're a YieldMax fan, it would be great. But in terms of strategy, it's very similar to what XDTE does, to be honest. If we do the total return, I already showed you guys T-SPY is a clear winner. We'll see what happens in the future. And in case you're wondering, why is JEPI not there? JEPI is not an officially S&P 500, okay? That's why it's not there. It's going to be in episode 3 where I go over the big cap ones. So that's it for the great S&P 500, guys. It's up to you which one you choose. A lot of great options. There's no right or wrong. And don't forget that if you're American and you only want American or US content, remember that I have a playlist called US Market Only Content. It's very easy. You click on the name of my channel, you click on the link, click on playlists. You'll be able to look at the playlists, and one of them is called US Market Only Content, right? For my American friends. And I do a monthly series if you want to be updated on all these S&P 500 covered call ETFs and the performance. Don't forget that I have a monthly series called the High Yield Covered Call ETFs and Stock Market Update. It's on episode 64. I do one for the US market, one for the Canadian market. It typically comes out near the middle of the month, where I not only go through the ones you saw, the S&P 500 ones, but also the NASDAQ ones and other ones. And think of it like I'm keeping you updated on the covered call landscape on the US. I also have a Canadian episode. Hit that like button. I would really appreciate it, guys. Make sure to check out the video description for my affiliate links and digital products and one-on-one coaching sessions. All that is in the link in the video description below. Next episode, covered call ETF battle number 2 is going to be the great NASDAQ 100s. Stay tuned for that one. Take care. See you next time.